Kiting. Oh boy, this is something that a lot of people get confused with, and it's something I got confused with a lot. This is a type of fraud. It is a scheme. We're going to talk about kiting. We're going to talk about another one as well. So, this is a type of cash fraud scheme in which an individual or a company, but for the purposes of what we think here, think it's just one person working at the company. They use a check from one bank account to cover a check drawn on another account with insufficient funds. You've got two bank accounts. I want to make sure you understand this here because you will see questions on this. You got two bank accounts, and the employee obviously has custody of it, right? That's someone has to have custody of the cash. So this particular employee has custody and the ability to take cash out. So they're going to take money out of this bank account B. They're going to take $1,000 out for themselves, and they're going to use bank account A, take $1,000 out of bank account A, and put $1,000 in here. Now you might think, okay, well, obviously I'm going to get into this much more, but you might think, how do they get caught? How do they keep doing that? Is it possible they do that with more bank accounts? Yes. And specifically how to do this successfully, well, there's no way to do this successfully. And if you are doing this successfully, then there's either a significant lack of internal controls or more fraud in the company or something. The perpetrator of the fraud takes advantage of the time it takes for the checks to clear, allowing them to spend the money in one account before the other account is debited. Now, someone doing this might just have no intention of keeping it sustainable. They're going to just do this for an entire month and try to get as much cash as they can and then just maybe flee the country, or maybe someone will try to keep this going as long as possible. Like I said, I'm not here to commit fraud. I'm just here to describe to you what I don't know why I commit fraud. Just obey the law. I don't know. It's not that hard, guys. Come on. So that's kind of what's going on. You could think of this as cash being recorded in two places. Like think of it like a flurry of cash. Kiting, it's being recorded in two places at once. If any of you are familiar with the concept of lapping, that is what we'll see as well. That's another cash scheme. Lapping is kind of using today's cash receipts to cover yesterday's theft. So signs of kiting could include a low average cash balance as compared to a high level of deposits, as kiting occurs when a check drawn on one bank is deposited in another bank and no record is made of the disbursement in the balance of the first bank. So you want to just, again, create kind of a flurry there. You want to take advantage of the time it takes for the checks to clear, and you're just going to just keep moving the funds around. Now, obviously, if a way to catch this is if you're an auditor and you see significant amounts of transactions between banks, but not really fluctuations in the overall cash balance, that's a concern for kiting. I'll repeat that again. Let's say overall the cash balance within a company stays at about $1 million over the course of a month, but you see they've got thousands of interbank transactions. That's a little sketchy. Why are you transferring money around so much if it's not going to someone or you're not receiving additional cash, right? You're just moving your own money around. That's definitely a red flag, and that's something you would have on a checklist to check for kiting. Kiting could be described as a constant process with the perpetrator needing to actively create a flurry of cash transfers. And as such, a way to detect or prevent kiting would be mandatory vacation time for employees with custody of cash. This is something we talk about with internal controls and possible fraud and segregation of duties to begin with as well. Mandatory vacation for employees with high risk jobs, high risk of fraud within them. If you make them take mandatory unannounced vacation to say, hey, you're still getting paid. We're not kicking you to the curb. You're just, hey, it's a random week. You're not working. Well, if this person is not working and has no access to their work functions, obviously this flurry of cash will stop. And then you'll be able to detect it and say, when this person stopped working, the flurry of cash stopped. Maybe they are related to the flurry of cash that's going on. If the employees are not working and not able to access the cash for a week or two period, the transfers will stop, the activity level will increase, raising red flags. I've seen questions as well saying, well, this is great, but in addition to having this procedure where you need mandatory vacation time for employees, you also need to make sure that you're actively monitoring for this, because even if you have this process in place, if you as a company are not watching out for employees and monitoring for it, this will just go right over your head. So something to keep in mind as we continue to move on. Now, as promised, we're diving into another cash scheme. As I mentioned, it is lapping. And lapping, this is another type of cash fraud scheme in which an individual or company uses incoming payments to cover up outstanding debts. This is it's very similar to kiting. Right? We've got that sort of similarity there, but it's different, and we'll talk about how it is. The perpetrator of the fraud takes advantage of the fact the funds from incoming payments are often not immediately noticed by the accounts receivable department. It takes time. So the cash received in a bank account what's our process, right? In theory, it would perfectly get communicated right away to the AR department, and they'd say, okay, let's apply that to the customer's balance. Hey, this customer who owed us money doesn't actually owe us money anymore. But obviously, there is a delay there. So the perpetrator of the fraud takes advantage of this delay just because that's, businesses take time. This allows them to use the incoming payment to cover the outstanding debt that they've taken out and delay or prevent it from being recorded in the accounts receivable ledger. Now, an employee may take funds received by a customer and not record it, instead using it for personal purposes. And to cover this up, the employee may use a later receipt to make up for the unrecorded one. Now, this is just going to completely devastate the financials and the accounting records because the cash application process, which I've got a slide on after this, we'll see that that's critically important. Cash application process is the process with which you are going to say, okay, cash receipt 1 goes to customer B. This is them paying down their bill. It's keeping track of who owes us what. So this, you can see, is just going to absolutely wreak havoc on that. As I mentioned, the cash application process, right? Because we're going to receive, let's say, $100, and that's going to have a remittance advice with it, and that maybe is from customer C, and customer C has a $200 balance with us. They owe us $200. So we would say, okay, the AR department's going to say, this gets applied, right? The cash application process, it gets applied to customer C's balance. And then we received $50, and that we had a remittance advice in there that says, this is for customer A. We're going to apply that to customer A. It's a constant process that you got to do, all the time, essentially, within an entity. And if you don't do this properly, you're going to completely have just an absolute mess of an accounting system of cash. That's something to watch out for. So this lapping is even worse because, who's to say which is worse, right? But from an accountant's perspective, this is going to make my job an absolute headache. Lapping conflicts with this cash application process. The process applies customer payments to the appropriate accounts receivable. It involves locating the customer's payment, matching it to the invoice or the account, and entering the payment information into the accounting system. And that's something that the lapper is going to mess with. Once the payment's applied, the customer's account balance is updated to reflect the payment. So customer C only owes us now $100. Right? That's just kind of the process. The cash application process, it's an important part of the accounts receivable system, helps to ensure the accuracy of the organization's financial records. Something I did for a client at one point, and can I tell you, it's pretty dang important. So it's something to be aware of. If you have to run your own company as well at some point, make sure you have a solid cash application process if you have a lot of different customers. How are we going to prevent and detect kiting and lapping? Well, let's see. What can we do to mitigate the risk of kiting? As we'll see throughout the exam, you can never fully eliminate a risk. You can only mitigate it. You can prepare a bank transfer schedule. For any bank-to-bank transfers that occur near the end of the year, the disbursement date on the check and in the ledger for the dispersing account should precede the receipt date noted by the bank and in the ledger for the receiving account. This is something interesting and really throws people for a loop when they see it in questions. You want to make sure that the dates line up. Now, especially for any transfers that happen near year end, because the perpetrator can use the concept of year end, as we've seen, it's inherently a little bit confusing. They can use that to make it even more difficult to detect what they're doing, and they can also do it at year end, right? It's a little bit easier for them to hide what's going on. So you want to make sure the disbursement date on the check, which let's say it's 12/28, a little bit after Christmas, right? After everyone's had all their holly jolly merry times. This is the check, and in the ledger for the dispersing account should precede the receipt date noted by the bank, and in the ledger for the receiving account. You want to make sure that, because if someone preliminarily deposited something without having it withdrawn from the other account, that's a concern. If this is the deposit, this is the check, and if this is the person writing checks and depositing them into their own bank accounts, right, creating that flurry, well, if they preliminarily deposited a check before they withdrew it from the other account, that would raise a significant red flag, right? So this is the receipts, and they're recording a receipt of cash the day before it was presumably deposited. That logically doesn't make sense. You're not going to deposit cash as a receipt before it was a disbursement. Obviously, a good check to look for. Also, checking that evidence exists that all deposits in transit and outstanding checks listed on the bank reconciliation at the end of the year cleared in the next period using a cutoff bank statement. Right, just looking at that cutoff bank statement, making sure that you tie everything from the bank rec out to that statement. What are we going to do to mitigate the risk of lapping? Well, you can confirm customer balances because if the customer balance is not being appropriately updated in the accounting system because someone's lapping, if customer C now owes us $100 and you send a confirmation to customer C and say, hey, we have you listed that you owe us $100, and they say, oh no, we actually sent you a check and we should be at a zero balance. And then you say, oh, that's not good. First off, check with them, make sure that's what actually is happening, and then investigate it. And then eventually you'll find that, oh, they did send us $100, but someone stole that money. Separation of incoming receipts from subsidiary accounts receivable, remittance advices. You want to make sure that someone possibly receiving the receipts doesn't know where they should go, and essentially assigning the cash application process to various people so one person can't take control of it themselves. Provision of timely statements. If you're just checking everything every day, it's going to be a lot harder than if you to commit fraud than if you check something every month. As someone who did the cash application process, the sooner I did it, right? If I did it every day, obviously it's a lot more work to do it every day, but it makes it a lot easier so that you're not trying to catch up on anything at the end of the week or the end of the month. Comparison of the details of bank deposits and the details of remittance credits, comparing the bank deposits to full list of remittance listing you have. Independent comparison of recorded cash receipts with the funds actually deposited. And lastly, utilizing this lockbox system, because if you have a lockbox system, kind of cuts out a lot of this to begin with because no one can have access to the cash. It goes right to the bank account. Now, obviously, if once it's in the bank account, someone is able to withdraw it from that, that eliminates that. But just another ability to mitigate, right? We're mitigating. We're not completely eliminating. Cost-benefit analysis. Got to decide what is best for your company. Let's talk about a practical audit situation. I mentioned this a little bit earlier, actually probably a lot bit earlier when we were dealing with AR and sales, but here we go. Salespeople have a personal financial incentive to maximize sales volume for their company. Okay, makes sense, right? They get commission, so if they sell $1,000, maybe they get a 2% commission on that. One way with which these individuals could do this would be to sell to customers who may not be creditworthy. That's a concern because we should check with our credit department, should we sell to this person, or is there a risk that they won't ever pay us? This is an issue as many companies have strict criteria to the quality of customers they will sell to in order to be more certain of receiving payment. Think about car companies, think about dealerships. They're not going to sell to you if you've got awful credit because you may not be able to pay that back. You might just run off with the car. If a company's salespeople sell to too many customers who are not creditworthy, the company may experience an increased expenses from high levels of bad debt write-offs. The salespeople are benefiting because they just get that immediate cash right away. But like I said, I've seen companies where the salespeople don't actually get their commission until they follow up and collect the payment. So that's actually a great way to mitigate this. Now we can also see this as well, a different mitigation factor. But yeah, if the salespeople are not getting paid until the company actually receives the cash, the salespeople are not going to sell to customers who are potentially not creditworthy. Another solid control to prevent the issue would be to separate the employees involved in the credit granting function from those in the sales department. So it's completely separated. And whenever the salesperson tries to make a sale, they have to get it approved by the credit department. And obviously the credit department's got their own things to worry about. They're going to be under fire if they approve anyone who shouldn't be approved. So they're not going to do anything for the benefit of the sales department. As we've seen with any internal controls, if there is collusion between these two parties, that's going to break down internal controls. But that collusion is one of the hardest things to prevent within fraud within an organization. Lastly here, we have finally made it. You guys are doing so great. You're doing well. Keep powering through. We saw this earlier. I just wanted to bring it up again. Being familiar with these pieces of audit evidence, just now that we've seen them in so many instances and how they apply to testing and procedures, right? Just make sure you're familiar with where these pieces of audit evidence come from, how they're used in the audit, how they're used by a company, and how the auditor can apply them to various procedures. That being said, it's my pleasure to finally give you a nice little summary and wrap us up for the day.
Hey there! Are you ready to not only pass your CPA exams, but truly understand and enjoy the material while studying? I know it seems impossible, right? Especially to enjoy the material? We'll do it together. Tap into the power of CPA.examprep.ai, where we've got personalized quizzes, multiple choice questions, memorization guides, flashcards, simulations, all tailored to your learning. Our adaptive study planning puts you on the fastest path to success and lifts you back up if you fall behind. Avoid wasting your precious time and money attempting an exam with a low chance of passing, because who wants that? We want to get you through this process as quick as possible. Our exam readiness prediction lets you walk in with confidence, knowing that you're prepared for success on exam day. Thankfully, there's no payment method needed to get started. So why don't you come join us? Visit cpa.examprep.ai and let's achieve your exam success together.